Started today. Today is Monday, November 7th. This is the 11 a.m. section. The section is being recorded. Here is the sign-in sheet. Make sure you sign this before you leave today. So today we're primarily going to talk about your Nike assignment and get prepared for homework 10 as well as your Dentsu group project. But before we do, I want to take a quick check on the Bloomberg Trading Challenge. So we go to Idea, Team Message. This is section 101. So these would be your portfolio rankings as of today. So two things. One, make sure you stay at least under 300,000 of available cash. That's good. Everybody's below that. And two, make sure that you have at least 10 longs when the trading competition ends in about 3 weeks. Okay, because again, the first half of the semester doesn't carry over. You need to do at least 10 longs in each half of the semester. Only 3 of the 6 teams have actually met that threshold so far. Okay, but that's just kind of a listing of the rankings here today. So back to the trading challenge. Again, we're kind of been in earnings season. Good opportunity for some stocks to move up or down based on earnings. So it continues to be an opportunity in the trading challenge. But any questions about the trading challenge? Or on the screen, just kind of here we are. All right, so let's talk about Nike. So as you were doing the as-is valuation of Nike, the first thing that you should have done for homework 9 is gone to Nike US Equity. You should have gone to FA. You should have found the tab you have under Custom for the model data export. You should make sure that you're exporting 6 years worth of data. It was just one of the defaults that we had set. And then you'd have gone to Export Excel, the current template. Right? So this would have exported the 6 historical years of Nike into Excel. Now, assuming that you have the Bloomberg plugin properly installed, and you didn't hit the data limit, then you would be looking at this data. Now remember, these are not numbers, okay? Because these are looking at data lookups real time from the database. So your next step would have been to select the tab, copy the whole tab that you've exported, right-click, paste special values, and overwrite these with numbers. Okay? And then the other part is that these long dashes are going to choke Excel, so we need to get rid of the long dashes, right? Easiest way to do that is copy the long dash, find, paste what you're finding, the long dash, replace them with zeros, replace all. And it should replace 41 long dashes with zeros. This is the file that you would save. Right? Any questions or problems exporting the Nike data? In this lab, did anybody have trouble with any of the computers in this lab exporting the Nike data? Because if you did, I want to alert IT so they can fix it. I heard some people had some trouble with the lab downstairs, okay, but that's a different story. Because the lab downstairs, they could actually hit the data limits a lot faster than this lab. This lab is not as well known as the lab downstairs. And more people from the university use the lab downstairs. All right? But nonetheless, we're on November 7th, so you shouldn't be hitting the data export limits in this lab yet. So back to Nike. Anybody have trouble with Nike getting the data? No? Great. So you should be able to have no trouble getting your next 2 assignments for next week and for your group project. Right? Now, once you've done this, you'd have then taken your, at this point, Costco model that you had built. You'd have opened it up and you've gone to the model data tab and you'd have copied all of that Nike data that we just exported, and then copy that and then paste special values, overwriting, sell for sell, all of the Costco data, replacing it with the Nike data. And again, assuming you did 6 years, it should work. And the way that you can tell that it should work is once you copy and paste the data, go to your CFI. All right. If your CFI is balancing, you're probably good in your data export. If your CFI is not balancing, then you got to figure out what's wrong. Right? If your CFI is not balancing and your TFI is not balancing, then you got a balance sheet problem. If your CFI is not balancing, your TII is not balancing, you got an income statement problem. And so then you have to go to our standardized income statement or balance sheet and figure out what needs to be fixed. Okay, so something about the model data is either missing or pointing to the wrong place, given the company, we have to fix that. All right, and I'm giving you a hint, Dentsu is going to be broken. When you put your Dentsu data in, it will be broken. It will not balance your CFI, and you will have to fix Dentsu. Okay, so alert. All right. Now, going back, once we've done this, we then go to our model data. We notice that 2022 is the last reported year. Nike's fiscal year ends in May. Okay, so they're actually in 2023 right now. So we go to assumptions, last reported year, 2022. Okay. Next assumption down, operating cash as a percentage of revenue, 2%. I don't think we're going to really be changing that this semester, so you can probably leave that one alone. Next, we need to put in Nike's WAC. Right? Over the weekend, it was 9.3%, but nonetheless, you have gone to Nike, typed in WAC, take a screenshot, save it. It's one of the screenshots you're going to submit, but basically there's the WAC. It still is at 9.3. Back to our assumptions. The next assumption here is the shares outstanding and the share price. We get that off of screenshot number 2, which is the DES screenshot. Again, take the screenshot, save it. Okay, 2 points. There's the shares outstanding. 1259.7 is the 1259.7. And then whatever the price is at the time you take the DES screenshot is the valuation that we're using. Right? Now, I had actually taken my screenshot over the weekend, right? And the opening price today for Nike was $95.79, right? But as I said, your screenshot could vary slightly in different price depending on when last week or through this morning you took that screenshot, right? But that's the one you're going to do your as-is model with, within a share price of $1. We then go to the third screenshot, EEO. On an annual basis, these are the next 4 years of revenue from 48,974 to 62,893. So that would be these 4 cells. All right. We then do the same thing with EBITDA. We get EBITDA here from 63.55 to 11,692. Type those in here. And then we go over to headline growth. Take these 4 growth rates from 4.85 to 8.9. And we type it in those 4 cells. Okay. And then the model will automatically estimate an EBITDA margin for each of the 4 years based on the forecast. And then finally, we're going to need these 2 second and third year multiples for EV to revenue and EV to EBIT. So again, yours will be slightly different because we based on the share price, but that's the point with the EEO screen. Here's your second year EV to revenue, third year EV to revenue, second year EV to EBIT, third year EV to EBIT. Now I'm actually not going to use the data on this screen because in my screenshot earlier today, before the market opened, at the the time, it was 2.84, 2.61, 2141, and 1781. But that's where you're getting the data from, the second and third forward year. When you do that, the model will estimate two perpetuity EBIT margins, one based on forward year 2, the other based on forward year 3. In this case, 13.3 and 14.7. Right? Normally, they're not that big a difference. Like, this is a pretty big difference for 2 years of trading multiples. Right? So in this case, we're going to have to either choose one of the two that we think is more representative of the perpetuity, or somewhere between the two. Okay, when we go to our next step. The next thing you would have done is you'd have gone to the ratios. First thing is you look at invested capital to sales, and what you'll notice is that historically Nike's invested capital to sales was anywhere between 0.29 and 0.31. So we're forecasting 0.31 in the future, so I probably don't need to mess around with the balance sheet ratios. All right? The productivity of Nike's been pretty stable over time, and it's about the range that we are forecasting given the current percentage of sales. So I'm going to leave the current level of balance sheet productivity alone. Right? We could change the balance sheet, but I don't think we need to. Which then says, okay, next, we need to find a realistic tax rate for the company. So we would have gone back to Bloomberg, look up to see if the company gave us any guidance, GUID. For the guidance, we don't have any tax rate guidance for Nike. And if you read through the notes here from the conference calls, here there's a row where Bloomberg picked out a call that basically said that they're expecting the mid-teens to be their effective tax rate. Okay, so you could have picked a number of mid-teens based on that, or you could have gone to option B, which is look at BRC. Look and see what the analysts were saying. So if we go to BRC, these would be the analyst reports for Nike. And I told you that JP Morgan typically puts a tax rate in there. Sometimes Deutsche Bank will as well, as Barclays. But I had chosen the JP Morgan report. And when this one opens, I can either visually look for tax rate, or I can search the PDF for the word tax rate, which makes it a little bit easier. And then I will see that JP Morgan is using a tax rate in the out years 16.5%, which is mid-teens, which is the guidance that the company is doing. So I think that's reasonable, so I'll change my tax rate to 16.5% for Nike. All right, next, I need an EBITDA margin. The number for Costco was something like 4.7% in perpetuity. If I don't change that, I'm going to get a really crazy share price. Again, for the trading multiples, I know my perpetuity EBIT margin is somewhere between 13.3 and 14.7. So based on their historical numbers, which is this row, I would say 14.7 seems more realistic than 13 something. So I chose 14.7. Except I can't make that cell 14.7 directly because it's not a yellow cell. So what I did is I estimated an EBITDA margin that gave me 14.7, which was 16.2. 16.2 minus the 1.5% depreciation gives me a 14% perpetuity margin. Now, I have to decide whether or not I want to smooth year 5 to go from 18.6 to 16.2. I happen to leave it alone, but I might want to smooth that. Make that something like 17 something on the way down to 16.2 so it's not so abrupt. And then finally, on this tab, I need to look at these 2 years of growth rates. Do I think 9% is reasonable? Or do I need to change those? I'm going to assume I think those are probably reasonable at this point for Nike. So once I've done all that, I need to get my share price within $1. So I go back to assumptions, and I need to solve for a G. 2 ways to do it. I can just keep manipulating the G until they get within $1. Or if I want to, I can actually use the goal seek function in Excel. So if I use the goal seek function for the G, then what I want to do is I want to set cell off of valuation, the share price, valuation D30, to the current share price of 95.79 by changing the cell G, which is B6, and then the solver will basically solve for, in this case, 3.9%. Okay, so at about a 3.9% G, that basically gets my share price to 95.79. So the G's in your model should be very close to 3.9. Okay, that's actually how part of the way TAs are going to grade it. Because the share price wasn't all that different in the last week from the current share price, which means you're going to get a G somewhere around a little under 4%. Shouldn't be a G of 7%, shouldn't be a G of 2%. Okay, that is the Nike as-is valuation. Questions? Questions about any of the numbers? How we got them, why we got them, what we did? Were you able to do this? Did you have any trouble doing this? Questions about why we did it? Because this is the process for updating your company. Now, the point of the as-is, which you'll then save and submit this file, which you did for your Nike assignment, is that we are backing out the assumptions, realistically, that lead to the DCF. Okay, so we have a pretty good starting point for the assumptions when we do our next 3 Excel files. Right? So now that we have done the as-is, we're going to now go to the next 2 files, which are called the bull and the bear. Okay? So conceptually, the idea is this. If we look at the target share price for Nike, and I'll go to A&R, look at what the analysts are saying today. Each of the analysts on Wall Street are projecting a target share price. This is a 12-month target share price. Basically what they think Nike's going to trade at over the next year. Okay? Now you'll notice that there's not agreement. Right? Here's an analyst that think Nike's going to trade at 77. Here's an analyst that thinks that Nike's going to trade at 185. Right? So even the professionals forecasting Nike don't 100% agree. Part of it is because we're talking about the future, right? But before we get to the target, which is what we think Nike's trading at, we need to establish a range, okay? The top of the range is called the bull. The bottom of the range is called the bear. And the idea is what's Nike's range of possible outcomes with a reasonable probability over the next 12 months, okay? And more importantly, why? Why would it go to the high end of the range? Why would it go to the low end of the range? So this leads to your papers. So when I say write a minimum 500-word paper, what you're going to be explaining are the assumptions that you use and why you use them. So what are the assumptions that we use? The primary assumptions, and there's 5 of them that we've basically done. Number 1, we put in an assumption for invested capital to sales. Leaving it alone is an assumption. Why did I leave it alone? I left the invested capital to sales alone in the as-is because Nike has had a pretty stable invested capital to sales from 0.30 to 0.32 historically. So I decided to leave it at 0.31 because I thought that was reasonable going forward. The productivity is not going to change. Assumption number 2, tax rate. I don't think I'm going to change the tax rate. Tomorrow there's an election. You should vote. Okay? But regardless of who you vote for, the likely outcome of the election is a very split government. Okay? No matter who wins, it's going to be very close to 50-50. Okay? Which means not much is going to get done in the next 2 years. Okay? And particularly with tax rates. If the Republicans try to cut the tax rate in the House, Biden will veto it. If Biden tries to push them to raise taxes over the next 2 years, the Republicans will ignore it. Nothing is going to change about tax policy for the next 2 years in all likelihood. So therefore, I'm not going to change Nike's tax rate going forward. Don't see a reason to do that. All right, going up. Why did I choose EBITDA of 16.2 and a 14.7 operating margin, assumption number 3? Okay. Basically, when I look at this, Nike is a premium brand. And seeing their operating margin grow, you can see that there, from 14.3% all the way to 17%. Okay? So I thought about the perpetuity, based on the 17% operating margins in the last couple of years in the forecast, I thought that 14.7 sounded more realistic than 13 something when I chose the perpetuity margin. That's why I chose the 14.7. Assumption number 4, sales growth. I left it at around 9% because I think that is high single digits, the rate of growth to be expected by Nike for reasons which we'll talk about in just a minute. And then finally, I solved for a G, which was a little under 4%. But again, I think that's a reasonable assumption given Nike's long-term above average growth prospects of being a premium brand growing in the markets that they're growing. So that's what I've explained for my as is, why I've used that data. As we go to the bull and the bear and the target, I will explain why I'm changing each of those assumptions. What is the context for doing that? Now, in order to do this, you need to know something about the company and the industry. So ideally, we would have done an EIC. Okay? But even if you don't do an EIC, at a minimum, look up a BICO. Okay, so let's figure out what's going on with Nike and its industry. Because these are going to be the assumptions that are going to be important to where we think Nike's going to trade. So if I go to BICO, what's going on with Nike? So on top of analyst minds, number 1, they're expecting low double-digit sales, but they're concerned about volatility because of inflation. Translation, high inflation could put pressure on their margins. So our assumption for how bad inflation is going to continue to be is going to affect our view of Nike's margins going forward. That'll be part of our scenarios. In addition, inventory is going to be an issue as well because supply chains are continuing to be disrupted, even past COVID. Look at what's happening with China right now. Apple just announced that you're going to have trouble getting an iPhone Pro because China shut down again, right, due to their zero COVID policy. And so basically it's caused them to have supply chain disruptions yet again. So we're seeing a world with supply chain disruptions, particularly global supply chains. How's that going to play out for Nike? Is this something that we get past and we kind of go back to where it was pre-COVID? Is this something longer term that companies are just going to have to deal with? That's going to affect, for example, levels of inventory and to some degree their ability to get some margins, right? Because if they have to pay more to ship goods around the world because supply chain remains more expensive, well, that's going to affect the margins as well. So that's going to be part of our margin assumptions, right? Now, in addition, Nike has a goal, you can see it right here, to increase their direct-to-consumer business from about 40% of sales to about 60% of sales. Why is that important? What might that affect going forward? Yeah. Part is revenue. What else is direct-to-consumer versus the way they're selling now affect? Versus wholesale? Yeah. Yeah, this is going to affect their costs and their margins. Because if they go through a wholesaler, they're giving up some of their margin to the wholesaler. If they go direct to consumer, they keep it all for themselves. So if they go from 40% direct to consumer to 60% direct to consumer, that's a reason to get higher margins. So the success of that is going to have a view of what we think the margins for Nike are going to be in the future. Everybody understand that? Make sense? So that's going to be another variable we have to start thinking about when we think about Nike. Another big opportunity for Nike is growth in women's apparel and shoes. Basically the athleisure market for women. They see that as a very important growth vector. Okay? So how big, how fast that grows, and to some degree how well they compete against companies like Lululemon for that market, are going to be very important in Nike's success. Nike also makes a lot of money off of endorsements, right? They sponsor shoes, athletes sponsor shoes, and that's very important to their premium branding. So when they got some idiot like Kyrie Irving making anti-Semitic comments and pissing off a bunch of people, that doesn't help Nike, okay? So they dropped him, right? They also dropped the shoe line that they were going to develop around him, right? Now, will that affect Nike? You can make that call. But that's actually one of the things now people have to start thinking about. Like if they have all these brand athletes and those brand athletes do stupid things, does that rub off in the company, right? Or can the company disassociate themselves with that and that won't affect them going elsewhere? You're seeing that now with Kanye, right? And his challenges that he's having with companies like Adidas and others that is causing problems with the brands. All right, so on the one hand, the brand strategy of associating with famous people or athletes has benefited these companies, but there are some potential downsides. How does that play? Does it play at all into Nike on a go-forward basis? And obviously, speed to market is important as well. They've spent a lot of money creating a digital-enabled supply chain, okay, so that they can be very responsive to customer trends. So does that mean that they can carry less inventory because they can be much more responsive to data? They can also get products to market faster than their competitors. But if you get the product to market, but you can't get it to the customer because there's supply chain issues, getting it from Asia to the US, well, that could also be a problem too that we have to start thinking about in our valuation. So what I'm telling you is as you go through the analyst reports and the BICOs, part of the reason is when we start doing our bull or bear and our target, these are going to be some of the things that we have to start to think about that are going to drive the assumptions to make the stock price go higher or lower. All right. Also, I know last year we were reading about Nike. They were actually going to try and sell more low price shoes. Like the sub 100 shoe market was important to them as a growth factor. They're not talking about that right now. Okay, but that was something they had previously talked about, and whether or not that plays out this as well. Because if they start pushing more lower price shoes, that's probably going to put pressure on their margins. They're not going to be as premium margin going forward if they go for value. Does that play out in our bull or bear scenario? Okay. So let's go back and to our as is. So this is our Nike as is at 95.79. So what I'm going to do is I'm going to do File, Save As, and I'm going to call this my bear. So I'm now going to put on my pessimistic view of the world of Nike, and I'm going to start changing some assumptions. So what assumptions might I change? Well, number one, they don't get 60% direct to consumer. Number two, inflation remains persistently high. Both of these factors put pressure on Nike's margins going forward. So remember in perpetuity where we chose 14.7 for the EBIT margin? These factors might push it closer to the 13.3. So in perpetuity, what I'm going to do is I'm going to change my EBITDA from 16.2 to 15. Okay, which is actually about where they were in 2024, not as bad as 23. So they still get some margin expansion over next year, all right, and even this year at 13, coming up this year in 23, but not quite as high as the 18.6, I should say, that they were expecting by 2026. It kind of compresses again, right? And so the supply chain issues catch up with them. The inflation is something they can't avoid and stays persistently higher longer term. And as I said, they don't get some of the growth in the athleisure market. Okay, so the women's athleisure market doesn't become as big as expected. So instead of growing at 9% a year, they grow at 6% a year. In the out years. I still don't think that it's going to affect the tax rate. I don't think that's really going to change all that much. So I'm going to leave that alone. But I do think that the G is going to be lower. Instead of 3.9%, it falls to 3.5% in perpetuity. They just don't grow as fast at the higher margins. So when I put all that scenario together, for those reasons, and making those changes that I just explained why I made those changes, then I'm getting a share price of 81.36. Now, generally, we're not going to change the WACC. We could change the WACC, but I'm not going to change the WACC. All right? The WACC is based on Bloomberg, and every now and then, Bloomberg, by the way, will create a wacky WACC. All right, because it's calculating based on real-time data, and based on that real-time calculations, it might give you some garbage number, and so the WACC doesn't make sense. And so in that case, we'd actually have to estimate a more realistic WACC for the company going forward. Okay. Again, this is where the analyst reports could help you. Go look at the analyst reports. What are they using for a long-term WACC of the company? That might give you some guidance as well. But nonetheless, you have to explain that as a changed assumption. In this case, I think Nike's WACC is probably realistic for the long term, so I'm not going to change that. Okay. Now again, if I want to get a little bit more pessimistic, I could say that their margin in the out years actually goes back to where it was in 2023 at 13%. And this doesn't go straight to 18.6 to 13 falls a cliff. It actually goes down to 16% and then 13%. And then my share price is closer to 70. Right? But what I've essentially developed is a bear scenario, a realistic bear. Now, like I said, we could have a zombie apocalypse and it could come and kill half of you tomorrow, right? But I don't think that the zombie apocalypse is a realistic probability. So I can just throw some numbers out there, but that's not the point of the exercise. So the point of the exercise is to put in what I'll call the realistic bear. What's realistic for Nike in the next 12 months? I think these are realistic scenarios on a pessimistic side that could end up with a $70 share price. So that's my bear. And that's my rationale for the bear. And I've written that up and I've explained those assumptions along the way. Questions about the bear? So I save this file. I close this file. I go back to my as is, file, save as, bull. Now I go to the other side of the range. Put on my rose-colored glasses, my happy pills. All right, what could go right for Nike? We just went, what could go wrong for Nike? We've established a floor. Now I want to start thinking about the ceiling. How high could Nike go in the next 12 months if everything goes right? So what could go right? A lot of what could go right is the opposite of what would go wrong, right? So they go beyond 60% direct to consumer. That athleisure market for women actually booms. That Nike continues to dominate the super premium brand and sells very high price shoes with celebrity and other endorsements that you still buy at higher prices. And as I look around the room, I see a lot of Nike shoes here, right? And I assume these weren't cheap, right? So that's the point. Nike does well in all of those scenarios. And that gets them higher margins at pretty fast growth rates. So back to the margins. Again, I'm going to leave the tax rate alone, but I'm going to actually change the margins here in the out years. EBITDA margin, 18.5. They grow and maintain their margins longer term. That's the expectation for the reasons that we just talked about. That they control their supply chain, that inflation abates, and we go back to more normal cost issues, and then Nike takes advantage of that as a global player. And so therefore they do get better margins because they have lower costs, right? And their growth stays high, single digits. I'm not going to make that higher, but high growth at much higher margins, same tax rate. The other thing is inventory. They are very digitally enabled and responsive with their inventory. And right now, they have 18 cents per dollar of inventory. They used to be closer to 14 cents. What if that digital enabled supply chain gets them back to 14 cents per dollar of inventory? Okay. And oh, by the way, then my growth is not 3.9, but it's 4.5 under all these scenarios for the reasons that I just explained. Leaving the WACC alone, that gets me to a share price of 123. Okay, so I've established my range. In a bull scenario, if everything kind of goes right, I think Nike could trade as high as 123, 122.50. If everything goes wrong, for the reasons that I just explained, I think Nike could trade as low as 70. So somewhere between 70 and 123 is where I think Nike's going to end up in the next 12 months. That's my range. The range doesn't have to be symmetrical. There could be more upside than downside. There could be more downside than upside. But what is that range? What causes you to go to the either end of the range? What changes or assumptions would you make, and why would you make them? That's what you're writing up. That's what you're explaining in your PowerPoint verbally when you talk about density. Questions about the bull and the bear? All right. So the final model is the target. The target is your opinion. By definition, that target must be between your bull and your bear. You can't say the upside for Nike is 70 to 122.50, and I think they're worth 140. Like, that wouldn't make any sense. All right, you'll get no credit for that if you submit that answer. So your target must be between your bull and your bear. Okay, so just where along the range do you think Nike's going to end up? What assumptions do you think are most likely to play out? Okay, now here's the deal. If your target price is within 10% plus or minus of the current share price, that's called a hold. If your target price is more than 10% of the current share price, that's called a buy. And if your target price is more than 10% below the current share price, that's called a sell. And that's how the analysts come up with their buy, sell, hold. Because the idea is if you're plus or minus 10% of the current share price, you're in a trading range, so there's no reason to really adjust your portfolio. Okay? You should only buy and accumulate more stock if you think it's undervalued by more than 10% or overvalued by more than 10%. That's the buy and the sell. So where do I think Nike will end up? Now I put in my opinion. And as I said, in the real world, I'll save my bull, go back to my as is. File, save as, target. You'll notice that the analysts, number one, a few of them came up with a bull much higher than our bull. So you can come up with a more optimistic bull than I did. And I can't say that you're wrong, you just got to justify it, right? Same thing, you can come up with a more pessimistic bear than I did, you got to justify it, right? But nonetheless, that was my bull and my bear for where I think Nike will trade in that range. So now what am I going to change? Well, I actually do think Nike's going to have a little bit of upside. I think their G is going to be closer to 4%, not 3.9. Okay? Because I actually think the market's got it mostly right. I think they will get to the targets that the market's expecting. Okay? I will expect them to get to their direct-to-consumer about what the market expects. I will expect them to grow their athleisure market, particularly for women, and that will improve their margins, and it might be a little bit higher than the 16.2. They will be able to maintain their dominant position, so maybe I think it's going to be closer to 17. Okay, so they're still improving their margin to where it was in 2021 and maintaining that. Okay, because they do have strong competitive advantage and strong brand loyalty amongst consumers, particularly when they're getting better supply chain issues by going direct to you as a consumer. And so I do think that they're going to have a slightly higher margin, and I think they are going to maintain that high single-digit growth rate. So when I put all that together and I leave the tax rate alone, I'm coming up with a share price of 101.84. Now that's a hold. Because I'm within 10% of the current share price of 96. So therefore, I'm a little bit more optimistic about Nike, but I actually think the market's got it mostly right. That's my opinion about Nike. You could come up with a different opinion, right? You just have to explain it. But that's the buy, sell, hold. That's the force models that you have to turn in. When we say write up, that's what you have to write up. Again, questions, comments about any of this? Concerns, crippling fears? Do you feel comfortable you could follow this process? Do you have any issues following this process? All right, so at this point, you would then submit 8 files. Your 4 Excels, your as is, your bull, your bear, and your target. You'd submit your 3 screenshots, DES, EEO, and WAC, and you submit your write-up, explaining why you changed those assumptions across the 4 models. Okay, that would be your next assignment. In 2 weeks, when you do Dentsu, you'll do that in PowerPoint. So you include your screenshots for Dentsu in the PowerPoint. You show your assumptions and what you're changing across the models in your PowerPoint, and you'll verbally explain that in 10 minutes. Okay? But your next assignment will be a paper. That's due 1 week from today. What if, and I made a mistake in the 8 a.m. section, but I think the mistake was useful. Okay? So what I had done when I was updating the Nike data and showing them is I actually typed the WAC into the wrong field. Okay, type the 9.3 here into the expected ROIC. So when I solved for the G, it wasn't close to 4%. The G was like over 10%. Okay, when I solved for the G. Now, if you have a G over 10%, that can't be correct. How do we know? Why would I know that 10% would not work for Nike? Why couldn't I put a 10% G? Yeah.
Because usually companies grow the economy and like I don't.
So that's one clue, but there's another reason, even more mathematical. Yeah. The G cannot be higher than the WAC in perpetuity. So the perpetuity, cash flow divided by R minus G, G can't be greater than R. Right? So you can never have a G greater than your R. If you do, you have an invalid valuation. Okay? So how would I actually solve for this? Like, what if I actually had Nike at a 9% perpetuity ROIC and they had value? Because basically, how do I value a company with negative spread in perpetuity to actually be valuable? Because if I grow a negative spread, it gets worse and worse and worse. We know that from key value drivers. So how do I value a company that has a high value in perpetuity if my model's showing a negative spread in perpetuity? What would I need to do? Because creating a crazy G is not the right answer. What would I need to adjust in the model here? Like if the year 6 ROIC for Nike were really 9%, how could I value Nike, which now has a share price of 70, how do I get this value to 95? What would I need to do if they had a negative spread in year 6? Well, let me ask you the opposite. What would cause Nike to have a share price closer to 95? What must be true about their spread? What must be true for Nike to have a spread of what to be 95 as a share price? The spread must be what? Positive or negative? Positive. So I know to get to the current share price, the spread's got to be positive. If my year 6 value is a negative spread, then what should I do? In perpetuity. Then I have to adjust the spread to be positive. I need to put in a more realistic ROIC. Okay? So just as I put in the accidental lower ROIC, the point is we're just using an ROIC in our model based on wherever it stands in year 6. Right? And if wherever it stands in year 6 is not representative of the long-term future as the market expects, then you're going to have trouble with your valuation. So if you have an unrealistic year 6 ROIC, then you have to put in a more realistic ROIC. Okay? So you might say, Why would I want to do that? Where would that occur? I just like to plug and chug and not think. Well, what if you were valuing Delta Airlines? And you looked at Delta, and you see in the RV screen that Delta, we go to operating ROIC, doesn't have one because last year they lost money. And so not only do they have a negative spread, but they have a negative ROIC. Should take a second to load here. So the point about Delta is that if these were the numbers in perpetuity, I wouldn't be able to get to a $21 billion market value because basically growing a negative spread like that in the long term is not going to give me a DCF that's big enough. So that would be the point. Like I would need to come up with a more realistic spread in perpetuity than a negative spread. 6 years may not be enough, right? I might have to forecast more than 6 years. But since we're not forecasting more than 6 years, then I just adjust that perpetuity value to a more realistic spread. So what might be a more realistic spread for Delta Airlines in the long term? What kind of ROICs might they make in the out years? How might we determine that? Anything we look at? Yeah. Yeah. I know sometimes I say I don't like looking at the past, but here's where the past might come into play. So I go to FA. And I go to custom. And I go to create custom. And just as an example, return on invested capital. Now this is Bloomberg ROIC, but I'll go back 10 years. So there's 10 years of ROIC. I know 2020 and 2021 are pandemic years, so that's not clearly reflective of Delta as a more normal airline. But before the pandemic, their ROIC was in 17 and 18, mid-teens, and in 2015 and 2016, mid-20s. I think 23 was an outlier, or 2013 was an outlier year at 85%. But 2012 was 27% as well. So that's the point. Like post-pandemic, if Delta recovers, they could get to mid-teens to low 20s as an ROIC. And so that would be the ROIC that I would use. Now, this is a little bit more subjective in terms of how to do this, but necessary if we're going to value Delta Airlines, right? Because you could actually see this in the EEO, okay? Because what's going to happen with Delta, if Delta were your company next week, and I'll go back a few periods, but in 2018, Delta had sales of $44 billion. 2019, $47 billion. 2020, $16.5 billion. 2021, $27 billion. They're still 60% of where they were 2 years ago. It's hard to make money when your volume drops by 40%. Okay? So that's what I'm saying. Like their current situation is not indicative of how they're being valued. You don't get to their share price by putting in today's numbers. Right? So by the way, if you look what the market's expecting, by 2023, Delta this year is about as big as they were pre-pandemic in 22. By 23, they're going to be bigger than they were pre-pandemic. 51 billion in sales. And then right after that, 53 billion in sales. So not only are they recovering, but people are expecting recovering and even more growth post-pandemic, right? So when we look at Delta, the Delta that's making $53 billion is going to have different levels of return than the Delta that's making $40 billion. And oh, by the way, that might change our view of perpetuity. Okay? So that's what I'm saying. Like, if you end up with a company like Delta and your model is giving you a terrible spread, well, that's because the current situation being played out might make it look like it's a terrible spread. And if the market's valuing it much higher than the as is, you might have to create a spread that is more indicative, that justifies where the market thinks the company's probably likely to go. Does that make sense conceptually? Questions about that? How we might think about that? Because this leads to your next homework assignment, right? So this morning, I was like, so, airlines, cruise ships. I gave the class a choice. Which would they want? And nobody said a word. So we're going to do cruise ships because we always do airlines. So basically, Royal Caribbean. Okay? That is your homework 10. Right? So as you start to look and understand what's going on with Royal Caribbean, I want to point out something. RCL is their ticker. For Royal Caribbean, pre-pandemic, their sales were almost $11 billion a year. In 2020, it went from $11 billion to $2 billion. In 2021, it went to $1.7 billion. Okay, this year is expected to go to $9 billion. Right, next year, the cruise ship company is expected to have sales of $12.6 billion. So you have to remember that in 2020, these were like the floating petri dishes that nobody wanted. They couldn't dock anywhere. If you were stuck on there, no country wanted you when COVID first started. And people were basically saying the worst thing you could possibly do is go on a cruise. Cruising was dangerous, and everybody abandoned the cruise industry, and these people were flat on their backs. Well, how the world has changed. I was reading this weekend that the cruising industry no longer requires COVID test or vaccines to go on board. You don't have to prove you're vaccinated, you don't have to take COVID tests. Just come on board. And you know what? People are flocking back to these cruise ships. We have decided that we're willing to live with the potential of COVID, and the world has moved on. It's happening in airlines, starting to happen in the cruise ship industry, travel in general, right? So there's pent-up demand for travel, people are going out there traveling, and basically they're just not worried about it. That's the current scenario. By the way, that's not the bear scenario. I can give you a different bear scenario out here that could really look a lot worse for Royal Caribbean, and then I can give you a bull scenario. But that's the point. You're going to talk to me about the bull and the bear, which means you got to know a little bit about what's going on with demand in the industry. Now, has anybody actually been on a Royal Caribbean ship before? You have? Have you been on a Carnival ship? Has anybody been on a Carnival ship? All right. So tell me about your Carnival experience. Tell me about your Royal Caribbean experience.
Just generally?
Yeah, just generally.
I don't have anything really compared to just like a normal cruise ship.
Normal cruise ship?
I mean, I don't have any experience compared against.
Okay. Have you been on, you have only been on Royal Caribbean?
Yeah, just the one.
Okay, which one were you on?
The Oasis.
So you're on one of their super mega ships.
Yeah, it was crazy.
All right, what was crazy about it?
I don't know, it was like a floating city, like, kind of, everything was just like so big. Also, it was like pretty fancy, I guess.
Okay.
But also like really expensive.
Was your Carnival ship super big? Not as big? So that's the difference. Like Royal Caribbean about a decade ago made a bet on these giant ships. They have 5 of them, which basically have about 5,000 passengers and about 2,000 crew. Okay? Just to put it into perspective, I think the original Love Boat from the TV show in the 70s had like 500 passengers. So these ships have gotten a lot bigger. Right? As a matter of fact, there's like, if you can Google this, like people like, are their ships bigger than the Titanic? Yes, by a factor of 3. Like these are big ships, right? Matter of fact, I'd gone to, for the last class, the Royal Caribbean website. Like these are their ships. And they're actually building a new one called the Icon of the Seas, which they have the largest cruise ship in the world. The Icon of the Seas will be even larger than the larger cruise ship in the world. It will basically have the ability to put 10,000 passengers, or sorry, 6,000 passengers and 2,500 crew. But just to get your perspective of these floating cities, like they're floating cities. You know, restaurants, you know, they're like floating hotels. They operate 364 to 365 days a year. Amusement parks, water slides, Broadway shows, all on here. But it's a pretty monstrous ship. But that the point is, this Icon of the Seas, which is their next class of service, is about a $2 billion ship. These are really high levels of investment for a $10 billion company. Okay? And they have 27 ships in their fleet. Okay? 5 of them, that's what I was asking which one you're on, the 5 new ones, are the monsters. And this is like the mega monster. Okay? They've got 2 mega monsters on deck. Okay? So that's their strategy, which is they're going to fill these big ships as almost a premium brand. Okay? And there's the Icon of the Wonder, which are the next 2. But you can see the rest of their fleet, including the ones that he was on. You count them up, there's 27 ships. So the question is, as we're starting to think about valuing Royal Caribbean, like, are they going to take some of these older, smaller ships and replace them with the mega monsters? Or at some point, can they stop building these mega monsters and monetize it? Because their ROIC right now is also under pressure because they're spending so much money on these ships. That's huge amounts of invested capital to build these ships, right? And so the question is that the market's got to figure out when you value Royal Caribbean is, do they keep building ships or do they stop building ships and finally monetize them? Because that's going to play out in the valuation. Okay? Because your ROICs are going to be different if they keep building a new ship every year or two. Okay? Versus if they stop building ships after this and then just monetize what they have for the next decade. So that's what you're going to be sussing out when you start thinking about Royal Caribbean's future, which is why I say you got to know a little bit about the company that you're doing the valuation of. But those are some of the issues that you're going to deal with when you do Royal Caribbean. Okay? So your assignment for next Monday, homework 10, which is 3% of your semester grade, is to do an as-is, a bull, a bear, and a target, as well as the 3 screenshots and the write-up on Royal Caribbean, explaining your assumptions along the way. Is an individual assignment, and that is your assignment for next Monday. 2 weeks from today, your assignment is Dentsu valuation as a group project. In that case, you'll select one of your valuation models. You'll basically put all the data in, and you'll create the PowerPoints for Dentsu, doing all the same thing, including the models. Okay? Now, in order to work on this, Wednesday is going to be another lab day. Okay? Because you're going to have to get a bunch of data, I'd say both Dentsu as well as Royal Caribbean. So I'm going to give you the lab to do that, to get all the data, and to do the research, because you're going to need to go into Bloomberg and learn about Royal Caribbean and the cruising industry, right? Because otherwise you won't be able to do the assignment effectively. And so I don't really have a lot more to say to you on the lecture right now. Our next lecture is going to be 1 week from today. Okay? Now, one word about the next lecture, which is, even though the group projects will not be until the Monday before Thanksgiving on the valuation, next Monday, we're going to start the 4th area of content on multiples. All right, so in the previous 2 sections, we kind of finished the section and then went on to the next section after the group project. This time, we're going to actually start the next section's content before we do your group project, because the end of the semester is coming up pretty quick. 1 month from today, semester ends. So essentially, I want to start on the 4th section of the content, which is multiples. So next Monday, or next week, I should say, will be the lectures on multiples, and there will be a homework assignment on multiples due that Monday before Thanksgiving as well. That will be homework 11, final homework of the semester, right? So just kind of giving everybody an update on what's coming down the pike. Questions about any of that? Yes?
So like what obligation do you need to start the project if you wanted to with your project, or are we
I would strongly recommend using some class time on Wednesday to get the data on not only Royal Caribbean, but also Dentsu, start talking to your team about how you want to start splitting up some of the analysis and evaluation, okay? Because again, you're going to be doing that 10-minute presentation on Dentsu, and part of it's going to be not just the numbers, but why you did the numbers. And so we're going to start talking about the same types of scenarios. Now, you can build on what you did for the EIC with Dentsu and you did a historical analysis, so you shouldn't go cold into the Dentsu company, but nonetheless, I would suggest getting the data. And the other reason I'm giving you a clue is I put the data for Dentsu into our model, and the CFI does not balance. So I'm warning you that you will have to fix the model for Dentsu. So to give you enough time to do that, I would start working on it this week, and I wouldn't want to wait till the last minute and scramble on behalf of your team. Okay? So that way, if you have any trouble about it, either the TAs can help you or we can talk about it in class next week. All right? But I'll give you a hint that it will be the TFI that's the problem. And specifically, it will be retained earnings. Okay? That's what you're going to have a problem with Dentsu. And what we're using as retained earnings in our standardized balance sheet. Okay? And actually somewhere in the model data is actually the retained earnings that they're using, which is not the standard field that I pulled from Bloomberg. So you might have to just readjust what the retained earnings points to in the model data to, and then everything will balance and flow. But you will still have to correct the model for Dentsu. Otherwise, you will have an unbalanced model. All right, questions about any of that? Pretty straightforward. All right, where's the sign-in sheet? This is up front here. Make sure you sign the sign-in sheet before you go. Again, no lecture on Wednesday. It's a Bloomberg Lab Day. Please take advantage of that to get your data for all these projects on Wednesday. Work with your teams. I'll see everybody 1 week from today for our next lecture. Remember, TAs have office hours this week as well if you want to work with them individually on any of these projects.